Get ready to explore risk management formulas. In this lesson, you'll explore powerful formulas that help traders decide how much to risk and how to protect their capital. We'll cover max loss thresholds, the Kelly criterion, and more, step by step. Risk formulas turn gut feeling into data. They show how much to risk per trade, how to avoid account blowups, and how to grow steadily. You'll learn how to apply them practically, even if you're not a math expert. Let's start with the most basic. Maximum loss threshold. This tells you when to stop trading. Common rule: don't let your total loss exceed 20% of your account. If you hit that, pause and reassess your strategy. Time for a quick quiz. You're using a 20% max loss threshold. Your account is $10,000. Based on your max loss limit, when should you stop trading? After losing $5,000. After losing $1,000, after losing $500, after losing $2,000? No, the correct answer was after losing $2,000. Not quite. If your max loss threshold is 20% on a $10,000 account, you're allowed to lose up to $2,000. Stopping sooner is cautious, but not aligned with your plan. Now let's explore the Kelly criterion. It's a formula used to find the optimal percentage of capital to risk based on your win rate and risk-reward ratio. The formula, Kelly percent equals win rate minus loss rate divided by reward to risk ratio. For example, you have a 60% win rate and a 1:5 risk-reward ratio. To calculate Kelly, we need a reward to risk ratio, which is 5. Kelly percent equals 0.6 minus 0.4 divided by 5 equals 52%. That means a 52% risk of capital if you want to maximize growth, but it assumes perfect conditions. Apply the Kelly criterion. Your win rate is 50% and your risk-reward ratio is 2:1. What is your Kelly? 10%, 20%, 25%, 5%. Yes, you're right. Great. Kelly equals 0.5 minus 0.5 divided by 2 equals 0.25 or 25%. In real trading, traders rarely use the full Kelly value because it assumes perfect conditions and no emotional error. Instead, many traders use half Kelly to reduce volatility and risk, quarter Kelly for very conservative growth that would be about 16.5% or 8.25% risk in our example. Here's how to interpret Kelly. A higher Kelly percentage suggests your edge is strong and you can afford to risk more. A lower Kelly percentage means your edge is weaker and risking too much could lead to large drawdowns. If Kelly is 0 or negative, your system likely has no edge and you should avoid trading it until it's improved. Knowledge check. Interpreting Kelly percentage. Match each Kelly percentage condition with what it tells you about your trading strategy. This formula-driven approach builds confidence, protects capital, and ensures their system stays adaptable, not emotional. Make a decision based on Kelly percent. You've calculated a Kelly percentage of 6%. Your current strategy has a 50% win rate and a 1:2 risk-reward ratio. You're about to place your next trade. What's the most appropriate action based on this Kelly percentage? Risk less than 6% to stay conservative and manage drawdowns. Avoid trading entirely. Kelly suggests there's no edge. Risk the full 6% on every trade, no matter the context. Risk more than 6% since the edge is positive. Yes, you're right. Good call. The Kelly percentage offers the theoretical maximum. Most traders risk less than that to control volatility and avoid large swings. Well done! You now understand how to apply formulas to manage risk wisely. Next, we'll shift to practical risk management, where you will apply everything you learned in a quiz.
What does leverage allow you to do? Reduce market exposure, increase margin requirements, control a larger position with a smaller capital outlay. Eliminate trading risk. You open a $50,000 position with 25:1 leverage. What's your used margin? $25,000, $5,000, $2,000, $1,250. With a $5,000 account and $1,000 in used margin, what's your free margin? $3,000, $1,000, $2,000, $4,000. What does trade exposure refer to? The amount of capital at risk, the remaining account balance, the full size of the position, not just the margin used. The broker's commission per trade. Incorrect. Correct answer: the full size of the position, not just the margin used. What happens when your drawdown hits your personal max limit? You shift to smaller time frames. You double the position size to recover. You close your trading account. You pause trading and reassess. Why is a 50% drawdown harder to recover than a 10% one? Recovery requires a 100% gain, not a 10% one. Brokers limit trading after a 50% drawdown. It signals the market is broken. You can't open trades after that. What's one smart way to reduce drawdown risk? Risk is only 1% per trade. Double trades in sideways markets. Increase trade size after a loss. Trade without a stop loss. According to the Kelly formula, if win rate equals 50% and R equals 2, 1, what is Kelly percent? 12.5%, 0%, 25%, 50%. 2. If your Kelly percent is 6%, what's the best risk decision? Double your position size. Always use the full 6%. Stop trading immediately. Risk less than 6% to stay conservative.